When the economy and markets slump, it is hard for everyone, but there may be some estate planning opportunities for certain groups, individuals, businesses in tough times. And Nicole Ewing, who is Principal of Wealth Planning Office here at TD Wealth, is here to talk about something called an estate freeze and how it works. So let's start off with what is an estate freeze, and then we'll get into like who this could apply to under what circumstances.
So essentially, an estate freeze would apply to really any type of capital asset, but primarily real estate, an investment portfolio in a holdco, or more often than not, a business, an incorporated business. And essentially, it's a transaction that allows you to freeze the value of that asset in today's dollars, with the expectation that it will grow and increase in value over time. And you can shift that future increase in value to somebody else, typically a family member, typically the next generation. Now, the reason that we do that is because if we don't need the value of that asset to fund our lifestyle or our legacy, we don't need the asset, but it's going to increase in value, and we're going to pay tax on that increase in value when we dispose of it or upon our death. So we're freezing the value in today's dollars, so we're also freezing our future tax bill. And we're allowing that asset then to pass on to the next generation in a more tax efficient way.
So this is not, my dumb question, this is, you're not disposing of the asset, but you are freezing it, so when you do dispose of it in the future, you're going to minimize the amount of tax.
That's exactly right. So it's a transaction that is essentially on paper changing the nature of your right and your ownership of the asset. So generally changing something that has the ability to increase in value to in exchange it for a fixed value.
And again, the obvious, because that's what I do, is because in this down market, this is the time when you want to do it because you have an expectation things will rebound, which we all hope where it's going. It's timeliness matters.
Exactly, absolutely. You would only be doing an estate freeze if you are expecting the asset to increase in value at some point in the future. Now, if your assets have depressed in value, that gives you an opportunity to freeze at a lower amount, meaning you've frozen your tax bill at a lower amount, and the future growth, which we would assume would be even more significant, will then pass to the next generation on that tax-deferred basis.
Got it. Okay. Who does this apply to? Who are the people who are most likely to be able to use this? And you said people who don't need the asset, but generally when you talk to clients, who's employing this?
A lot of different types of clients. So this is essentially you have significant assets, you know that you're not going to need those funds, so we're talking about high net worth, ultra high net worth individuals. I've worked with people who sell heavy machinery, and they were passing on the business to the next generation, to their family, wanted to maintain control, but to freeze their future tax bill, and so they executed a freeze that transferred that through a trust to the next generation. Also worked with a plumbing family that had built up a significant business in as plumbers, and we're again going to pass that on to the next generation. So we're really thinking here about family businesses of all shapes and sizes, but we also see this used by high net worth individuals who have investment holding companies, and they have investment portfolios again that they expect to increase significantly in value, and they are freezing the value by issuing. Then there's the technicalities of it is to essentially freeze the value and give the shares, the common shares, to somebody else.
So we're not going to get into the weeds on this completely, but more just at a high level. How does it work in terms of timing? Is this something you say, okay, I'm going to freeze my estate and it's done tomorrow? I know the answer.
No, it does. Timing is really critical. It's critical for a bunch of reasons. One, to make sure that you're not doing it too early, because if you need those assets and perhaps you've misjudged where inflation or the cost of living may take you, you might need those assets in the future. We also have, it's very typical that this is done using a trust. So I will keep the preferred shares and issue new common shares to a trust with a variety of beneficiaries. In Canada, we have a 21-year deemed disposition within a trust. That means that it's going to, every 21 years, you'll either have to pay the tax bill or roll those assets out to the beneficiaries. So just something to keep in mind
Yep.
from a timing perspective. Really want to make sure that you have enough. And some people would pretend to do a partial freeze. So say, I'm not ready to fully lock in, but I will do a portion of the assets that I own, and there's no reason why you can't do that.
So partial freeze being just part of the assets. It's not some term of a different kind of freeze. It's just part of and not all of it.
Exactly. So say I own 100% of the common shares of this corporation, and I'm going to trade half of my common shares for preferred shares. I still keep the other half, and I can give new growth shares, new common shares as well to other individuals.
Interesting. What about, and I know you and I were chatting before, there's something about the long-term capital gains exemption that is interesting with this strategy.
This is very often used in combination with the lifetime capital gains exemption, which allows owners of qualifying small businesses to have $1.25 million, just recently been raised to $1.25 million of capital gains exempted from tax. When you do an estate freeze, typically again through a trust, it allows you to have the lifetime capital gains for your own shares as well as for any of the beneficiaries of that trust. So we see it multiplying. So if my business, for example, was worth $10 million, $1.25 million is sheltered through me, and I can allocate out the additional amounts to beneficiaries of the trust, and they can use their lifetime capital gains exemption to eliminate the gains on their $1.25 million as well.
That's good.
It's very good, and this is why having this as part of an overall strategy, particularly if this is an operating business, we want this to be part of the overall succession plan, looking at the goals that you have for your, not just currently, but also for your family as a whole. There's some technicalities here that can get you a little bit tricky. So if, for example, there's US beneficiaries in the mix and you're putting them into the trust and they're going to be potential shareholders, that can make this plan not work as intended, and it can be very expensive. So there are a lot of costs associated with this as well to keep in mind.
I've got about a minute. I want to make sure that we talk about this. So timing the market is always hard, but there's sometimes some obvious times and just things that may make sense. For those who are concerned about getting it wrong, like maybe freezing at the wrong time, but how do you work with it? Because this is one aspect of an overall plan when you work with an advisor, right?
When you're working with your advisor, firstly, they're going to help you do the projection to determine how much you have, how much you need, and how much surplus there will be at the end of the day, how you're going to fund that tax liability at the end of the day. So they can project all of that and give you the math to show you what the possible outcomes may be. They can also connect you with other professionals, but you need to be coordinated with your accountant in terms of doing this in the most tax-effective way, with your lawyer, and perhaps with the future purchaser of your business as well to understand how that's all going to go.